On Thursday, February 24th, 2022, Russia invaded Ukraine. As I record this, Ukraine has been under siege for 2 weeks. War is horrific, and my heart hurts for those who have lost loved ones and have been displaced from their homes. In addition to the current humanitarian toll, this conflict carries with it some very high stakes. For the West, it could mean the possible reunification of powerful former states of the Soviet Union, starting with Ukraine, then possibly Moldova, and then others. Such a reunification could rekindle the Cold War and return the world to a state of fear of nuclear conflict not experienced since the fall of the Berlin Wall in 1989. For the Russian Federation, failure could mean the eventual admittance of Ukraine into NATO, posing a threat to those in Russia who still fear the West as a result of the Cold War. The West has been hesitant to send troops to assist Ukraine. Russian President Vladimir Putin has already threatened nuclear retaliation against nations that interfere. Instead of military action, the nations of the West have waged economic war. One of the biggest actions to date has been the banning of Russian banks from using the SWIFT system, which is the Society for Worldwide Interbank Financial Telecommunications. This is the system that underlies the international transaction settlements. The hope is that by disconnecting Russian banks from SWIFT, it will make it easier to enforce economic sanctions. Many of those economic sanctions have yet to be put in place. And one of those sanctions is the banning of imports of Russian crude oil into the United States. U.S. President Joe Biden announced the ban on Tuesday, March the 8th. He's hoping that other nations will follow suit. Will the ban of Russian oil imports have a significant effect on Russia? Or is this largely a symbolic gesture? How likely is it that Europe will also ban imports? And I will examine these questions in this video. Let's start by taking a look at the year 2020 crude oil import and export data as supplied by the BP Statistical Review of World Energy 2021 edition. This table summarizes the oil imports for the 5 nations and trading blocs that import more than 100 million metric tons of crude oil per year: the United States, Europe, China, India, and Japan. I left out smaller importers of oil to reduce the size of the table. Along the left-hand side of the table is the list of the nations and trading blocs from whom oil is imported, followed by the amount of oil in millions of tons per year imported from each producer. For example, we can see that the U.S. imported 179.7 million tons of oil from Canada in 2020, whereas it imported 24.9 million tons from Saudi Arabia. In the center of the table is a list of total exports from each of the producers. These totals are higher than the data on the left due to the fact that I left out the importers of less than 100 million tons per year. To the right of the total exports is a calculation of the percentage of a producer's exports imported to each of the 5 major importers. So we can see that 94.9% of Canada's crude oil exports were sent to the United States, while only 7.1% of Saudi Arabia's exports were sent to the United States. At the bottom of the table is a list of the total imports for the Big 5, followed by the percent of imports obtained from Russia. Now, I highlighted in blue the data that I found to be pertinent to the current question of economic sanctions against Russia. Notice that the U.S., who was the first and only nation so far to ban Russian oil imports, imported only 3.7 million tons of oil from Russia in 2020. To put this into context, this is only 1.3% of the total crude oil imported by the United States. Since the U.S. is a major producer of oil, the 3.7 million tons represents an even smaller percentage of total U.S. consumption. So we can see that the U.S. ban of oil imports from Russia poses a very small risk to the U.S., which is probably why the U.S. did not hesitate to ban oil imports. Now, is the ban a threat to Russia? Probably not. That 3.7 million tons represents only 1.4% of all of the oil exported by Russia to the rest of the world in 2020. The impact is likely to be more symbolic than real. It is an insult rather than an injury. But what if the U.S. succeeds in inspiring the rest of the world to take action? We can see from the table that Russia sold 53.2% of its exports to Europe in 2020 and 32.1% to China, which is 85.3% between the two of them. In order to truly deliver meaningful economic damage to Russia, one of the two will have to ban oil imports. China is not likely to do so. It has remained rather silent on the Ukraine issue and may be watching events unfold to gauge how the West would likely react to any military action in Taiwan. So, what about Europe? With more than half of Russia's exports going to Europe, it surely would deal a meaningful blow to Russia if the oil trade was halted. Now, to put the European import of 138.2 million metric tons into context, let's put a dollar value on it. There are a little over 7 barrels in a metric ton. So 138.2 million metric tons is close to 1 billion barrels. Considering Brent crude is currently trading for over $100 per barrel, it means the Russia-European oil trade is worth more than $100 billion. Now, this is more than Russia spends on its military each year, which is $60 million to $80 million per year according to Trading Economics. Will the European Union act to ban Russian oil imports? Well, anything is possible, but I don't think it's likely. Notice that in 2020, nearly 30% of European oil imports came from Russia. In addition, taking action might inspire Russia to cut off natural gas and coal exports to Europe. Of the 114.8 billion cubic meters of liquid natural gas imported into Europe in 2020, 17.2 of them came from Russia, which is 15%. And of the 447.1 billion cubic meters of pipeline natural gas that was imported, 167.7% came from Russia, which is 38%. And of the 3.9 exajoules worth of coal imported into Europe, 1.96 of them came from Russia, which is 50%. Now, we used to speak of mutually assured destruction, or MAD, when it came to nuclear arms proliferation. If there was an economic equivalent, this might be it. But 2020 was an unusual year in the world of energy. Government actions in the face of the global COVID-19 pandemic resulted in significant reductions in travel. Airline travel was severely curtailed. Many workers were furloughed or laid off and no longer needed to travel to work. Of those who remained on corporate and public sector payrolls, many worked remotely thanks to developments in telecommunications technology. It's natural to ask now that we seem to be emerging from the other side of the pandemic, whether the energy picture is likely to change. And while we can't yet tell what the energy consumption picture will look like in 2021, we can use a pre-pandemic report to get an estimate. Let's look at the same data from the 2020 BP Statistical Review, which covers 2019 consumption and production data. This table shows the 2019 numbers in a similar fashion to what was presented in the previous table. The absolute value of most import and export numbers are larger than they were in 2020, as expected. However, the percentages highlighted did not change appreciably. In a more normal year, it would appear that about 2% of U.S. imported crude comes from Russia, and the U.S. imports represent about 2.3% of what Russia exports. So our conclusion is the same. Banning the import of Russian oil into the U.S. is not likely to have a major impact on either the U.S. or Russia, other than its symbolic meaning. We can see that the same high-level conclusions can be drawn for China and Europe. About 15% of China's imports come from Russia, and China's imports represent nearly a third of Russian exports. About 29% of Europe's imports come from Russia, and Europe's imports from Russia represent over 50% of Russian exports. So while the U.S. is more at liberty to take action without major economic consequence, Europe and China have much larger energy ties with Russia. So what's to blame for high oil and gasoline prices? Why did the price of oil climb from about $60 per barrel, in terms of West Texas Intermediate, pre-COVID, to its current level above $100? Why are gasoline prices now well over $4 per gallon in the United States? I'm inspired to invoke the spirit of the late Milton Friedman, who once said, "Inflation is always and everywhere a monetary phenomenon, in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output." So let's take a look at what the Federal Reserve has done with our money supply to combat the effects of the pandemic. This figure shows the M2 money supply both before and after the pandemic. Remember, M2 is currency in circulation plus demand deposits plus savings deposits plus time deposits and money market accounts. You know, spendable money. Before the pandemic, M2 was rising gradually and stood at about $15 trillion. Over the past 2 years, the monetization actions at the Federal Reserve caused M2 to increase to almost $22 trillion, which is nearly a 50% increase. During the pandemic, economic activity was muted, and so price increases did not result from the money supply increase, at least not right away. Now that we are emerging from the pandemic and COVID restrictions are being lifted, the effect of the additional money supply may be beginning to be felt. Is it a surprise that crude oil prices have increased? Even without a war, how could they not? Once the situation in Ukraine has been resolved, the price of oil may drop, but don't expect it to go back to pre-pandemic levels.